What's going on YouTube? My name is Emmanuel and welcome to ICT Room. In this video, we're going to be discussing the key concepts to mastering your daily buyers. So without further ado, let's jump into the video. What you see in front of you is just a pattern that everyone is familiar about. If you have been in front of the charts, you know this pattern. You know that the market will create higher highs and higher lows, lower lows and lower highs. So in this case, we're going to look at those higher highs and higher lows as liquidity areas. Every high and low in the market is a liquidity pool. That's where the orders are. We have sell stops, we have buy stops on highs and lows. Okay, so in this schematic right here, the market has created a high, a lower high, and then a higher high, a potential higher high. There's something that needs to happen on this high for us to consider it a high. Okay, so I'll talk about that in a moment. So right here, we are bullish because we broke the previous high and closed above. Okay, now we see that we're bullish. We're breaking highs and rejecting lows. So since we broke this high, we know that we are bullish, but that doesn't mean we must always be buying. We must know when to buy and when to sell, because we can't keep buying when price is at what? At premium. You can't buy something that is too expensive. All right, you must wait until it becomes cheap or it is on a discount so you can buy it. Simple as that. Same thing on the bearish side. If we are on a discount, we can't sell something at a cheaper price. We must sell it when it's expensive, so that we can get what? Profit, reasonable profit. So going back into the bullish scenario, we took this high. This high is considered as our what? Our buy side liquidity, because each and every high and low in the market is what? It's liquidity. So if we take a high, it means we've taken out what? Buy side liquidity. So when we move higher, we can keep buying and keep buying and keep buying until we see some sort of a pattern that I'll show you in the next slide. And then after seeing that pattern, that's when we can look to do what? To reverse into what? Into a discount, or potentially to this low, because it is what? Our sell side liquidity. So same thing here. There's a pattern that will happen here. When this pattern happens, that's when we know that the market is about to reverse from a discount to a premium, or potentially it can sweep or run through this high, this buy side, because the market always seek liquidity. You will never know what it will do when it gets to the premium. The only thing that will tell you is what will happen when the market gets here. So if you want to sell from this premium, you must wait for a certain pattern to happen here so that you can sell. Same thing here on the discount. The same pattern that happened here is the same pattern that must happen here on discount for you to consider buying, because there will be PD arrays here and also here. So the market will tell you if it is respecting those PD arrays or not. If you don't see those patterns that I will show you in the next slide, don't buy here. Same thing here. If you don't see the patterns that I'll show you in the next slide here, don't try to sell. Simple as that. So let's move to the next slide, and then I'll show you the patterns that I'm talking about. All right, guys, this is the daily time frame patterns. Everything that I'm talking about here is on the daily time frame. Take note of that. So this is our first pattern. It's our first reversal pattern from a bullish market to what? A bearish market. So this happens after we took buy side liquidity or after tapping into a PD array or a key level. Same thing here. This is a bullish reversal pattern. We're bearish and now we're expecting to reverse and go bullish. So this happens after taking out sell side liquidity or after tapping a key level or a PD array. So another one is here. We have this kind of pattern after we took buy side liquidity. This is also a bearish reversal pattern. This pattern happens after we took buy side liquidity or after tapping inside a key level. All right, and then here we have a bullish pattern which opposes this one. This pattern happens after we tap the key level or took sell side liquidity, where this pattern we take the previous candlesticks high and low. Same thing here. Whereas this one, we have the first candlestick which must be lower than the second candlestick, and also the third candlestick must be higher than the third candlestick. I mean, the second candlestick must be higher than all of these candlesticks. And then we come to this one. We have the first candlestick, which is this bigger candlestick. And then we have the second one, which is the second candlestick must be in the middle. This candlestick must fail to close below this one after it has tapped the key level. When it fails, the third candlestick must close above the first candlestick. So you can trade this first candlestick, but it's risky. So I myself wait for this candlestick to close. This candlestick to close. I wait for it to close, and then I enter on the third candle. I wait for this one to close, and I enter on the third candle. If I'm going bullish, I enter on the third candle below the open. If I am going bearish, I enter on the third candle above the open. Same thing here. When this candlestick, this bigger candlestick, takes the high and closes below the low of the previous candle, I use the body of this previous candlestick, the body of it, the low of the body, as my key level. I use this as my key level. Most of the time, the market will come back to tap this candlestick before going down. So this is where I enter. Same thing here. I'll enter on the body of the previous candlestick. The market will draw back here before it goes down. Not always, but most of the time. So since we've discussed everything that you see in this picture, I want to show you the key levels that I use every single time I take a trade. These are my key levels. As you can see, we have a fair value gap, and then we have an order block. So a fair value gap is a three candlestick pattern where the wicks of the first candlestick and the wicks of the third candlestick fail to overlap and leave a gap in between. So that gap, we consider it as the fair value gap or an imbalance. We can call it whatever we want, but at the end of the day, it does the same thing. So when the market taps inside this fair value gap on the daily time frame, take note, on the daily time frame. I'm repeating this because it's important. When the market taps inside this fair value gap, and then you see one of those patterns that I showed you on the previous slide, do not hesitate to take that trade. It is the one. Okay, same thing here. When the market comes to tap into this fair value gap, and then you see one of those patterns that I showed you on the previous video, on the previous slide, don't hesitate. Just take that trade and then hold it to at least a premium, or aim for the high that is right here, or the low that is right here, or a discount if bearish. Same thing here. If the market taps inside this order block, on the bearish market it taps inside this order block, and then you see one of those patterns that I showed you on the previous slide, do not hesitate to take that trade. Do not I repeat, do not hesitate. It is the one you've been waiting for. Just take that trade and hold it to this low, or to at least a discount. Same thing here. Wait for the market to tap into the order block, and then after you wait for that pattern to form. This is important, guys. You wait for that pattern to form. You wait for the market to show you that pattern. Once you see that pattern, that's when you can start trading. All this time you must be waiting for the pattern. First, you wait for the market to tap inside your key area, or to take buy side or sell side liquidity, and then wait for the pattern. Once you see the pattern, don't hesitate. Enter on the third candlestick. And target opposing liquidity, or target a PD array inside premium or discount. That's it. You're done. So without further wasting time, let's jump into the chart and I'll show you real live examples. So we're here, guys, on TradingView. So look at here. When you look at this picture here, look inside this box and tell me what you see. Pause the video and check. Okay, let's continue. So in this scenario right here, we took this buy side liquidity here. This was our buy side liquidity. After taking that buy side liquidity, you can buy. According to me, you can, if you can continue buying, until this happens. Do you remember this pattern? This pattern where the market takes the high and the low of the previous candle and closes below the candlestick. And then this candlestick is what? Your key area. The market will draw back into this area to give you a chance to get in, so you can target what? A PD array on discount, or you can go for what? For this low. Your choice. Which one you go for. You choose which one you go for. But for me, I would advise you to go for a PD array on discount. This is called the low hanging fruit. You take profits on the low hanging fruit, or you can take the majority of your profit and then you lock your profit. You take majority of your profit and then hold the trade until it gets to this low. Because if the market reverses here and hits your stop loss, you've got nothing to lose. But if it goes with you, then you have everything to gain. All right. Yes, this will be our second example. We've taken out the buy side liquidity right here. And then after taking out that buy side liquidity, we have an order block right here. As you can see, with that order block, let me check. Did we respect? Yes, we did. We have an order block right here. So when the market came to tap inside this order block, look at what happens. Let me remove this for you can see it clearly. Look at what happens after we tap inside this order block. This pattern. Do you remember this pattern when the market takes the low of the previous candle and failed to close, and then the third candle closes up, the body of the third candle closes above the previous candlestick? So this right here is your order block. You buy here. When the market comes back to tap inside this area, you buy. Simple as that, guys. Simple Simple as that. Again, right here with a swing high with the high, the higher high, and the higher low. This is a swing high. This is liquidity. After we've taken out that buy side liquidity, right here, we have an order block inside that buy side liquidity. This is an order block. Okay, the importance of waiting for the pattern to form. Okay, so if you were someone, you would have entered once the market taps into this order block. You would have entered here and then went higher. You might have made profits out of luck. But if you are someone like me, you would have waited for this pattern to form where, let me remove this, where the market takes the low of this one, of this previous candlestick, and fail to close below. And then you buy from this one, from this third candlestick. And in this case, if you would have targeted the high, you would have been unlucky. But if you would have done what I told you on the first example, you target your PD array on the premium, and then once you hit that target, you take your stop to break even, and then take majority of your trade. Then if your market came down to hit your stop, then you had nothing to lose. Simple as that. Here is another example. This is where we took what? Buy side liquidity. But look what happened here. We have a fair value gap. What is this? A key level, a key area. So if you see this pattern inside a fair value gap or inside an order block, forget about everything, forget about anything. As long as you saw this pattern, just buy the third candle. Don't hesitate, just buy the third candlestick. We have another one here. So we took buy side liquidity. You see, this is our buy side liquidity taken out. And then look at this, look at the pattern. We took the previous candlestick's high and failed to close above and close inside. Look at here. What do? You sell what? The third candlestick. Simple as that. You sell the candlestick and you're going down. You're killing, you're milking, guys. You're milking, you're targeting this one, this low, potentially this low, and you've taken majority of your profits on what? A PD array inside what? Inside the discount. So I hope you find this video useful. I'm really looking forward to helping you in your trading career. Thank you very much. This is ICT Room. Peace.